Hi, I'm Dan Danford. We're doing a series of podcasts for Dad's Divorce called Money Made Easy, where we look at financial topics that might be helpful to viewers, helping them sort through issues and things that they're encountering in their lives. Today I want to talk a little bit about the uses of and need for some kind of annual review. I know a lot of different people who kind of work in different areas of finance and investments and other kinds of things, and they all have their own schedule. For most of us, or many of us, the end of the year and the first of the year is kind of that opportunity. As we gather things for our taxes and all the issues that are related to the end of the year, it's a good time to kind of sit down and take stock and to look at things. So what I want to help you do maybe is know the things to look at. Okay, because there are a whole bunch of things that are important financially. And I just think that some sort of review process is good for almost all of us. First thing, and this seems very obvious, and that's just to take a look at your various investment statements. If you have money in the bank and you get a statement every quarter, if you have mutual funds or you have stock or brokerage statements, just gather those together. One of the things that happens is, one family might have 6 or 8 different statements. They might have IRAs for both spouses. They might have 529 college accounts for their kids. They might have a joint investment account or a CD account at a bank. And very rarely do we sit down and look at all of those things together. And that's what we'd like to do at this point. Not so much because you want to make changes, but just so that you've got a good idea of what you actually have. Because the next step of the process is what I call rebalancing. And that's the point where you could have 6 or 8 different accounts. If they're at different locations and if they're invested differently, you might have 20 or 25 different mutual funds or different bank accounts or different kinds of stocks or bonds or whatever. And it makes sense to kind of classify those things. The things that are stock funds, perhaps, or international funds, or the things that are bank deposits. And get an idea across all those how much of your money is in, say, stocks, and how much of your money is in bonds or money market accounts. And then probably the biggest issue is, as you look forward, what should your mix be for your situation? This may call for some adjustments to be made. You may decide, when I look across all these accounts, I notice I don't have any international investments. And so what your decision may be is, I may want to add some. And it may not make sense to add it in 6 or 8 different places. Maybe what I'll do is add all my international investments in one account. Really, that's a really sensible way of taking care of things. But if you don't go through this process, you never realize what needs to be done. So the first step is, let's look at what you've got. The second step is, let's do some rebalancing if it's necessary or helpful. The third thing that I talk about, and this is especially applicable at the end of the year and the first of the year, but you could do something like this almost any time. And that's to kind of, what I say is, make a trial run of your income tax statements. Most of us use the Form 1040, but you may use the 1040A or the 1040EZ. Doesn't really matter. But if you do it in advance of when it's really due, it may point out some things that would be helpful. One of the issues is, especially if you're towards the end of the year, you may be able to adjust your income so that it's more favorable for you. A good example would be if your family income is nearing a switch in the tax bracket, and you can see that if you made, say, an extra $5,000 this year, you would have to pay a higher marginal tax rate on that. Well, maybe what you decide to do in that circumstance is, when the boss comes in and says, hey, we're going to give you that $4,000 bonus for all your good work last year, you may say to the boss, it would work better for me and my family if I'd wait till January to take that. Because then you can put it into next year's income and might not be in that higher marginal tax rate. So one thing is, you might be able to adjust your income from one year to the next. Another way to fix that, same issue. You've got a bonus coming in, you know it's coming in. You've wanted to make some charitable contributions, or you're already obligated to make some charitable contributions next year. Well, what you might do is go ahead and take the bonus payment in December, and at the same time go ahead and pre-fund your charitable contributions for next year. And then all in this year's tax year, you'll be able to show the extra income coming in and also a charitable contribution to offset that, and you'll keep yourself in the lower tax bracket. All kinds of things. If you have too much, say, interest from your investments, well, interest and dividends are taxable as income. Well, you might decide to reallocate or rebalance your investments so that you have less taxable income. You might move from dividend-paying stocks to stocks that tend to grow in value but don't pay high dividends, because if you do that, then you won't have to pay taxes on the dividend income. Anyway, there are just a whole bunch of things that you can do as you review your taxes. Now, many of us in many years, will look at our tax return and it won't change our behavior because there's nothing big there that we can do. But the thing is if you don't do it in advance of the year end, then there's nothing you can do about it. And then maybe the last step and the most important step in the evaluation process is some sort of comparison. Now, I run into this in my business all the time. We manage money for people. And people will come to me and they'll say, I looked at my statement and I could have done better last year if I'd put my money in bank CDs. And there are years when that's true. Okay, I can pretty much guarantee that was true in 2008. It may be true in 2009. It could be true in any other year or any other 6-month period. But that's really not a fair comparison. What's a fair comparison is if you have part of your investments in stocks, then you need to compare your performance against Dow Jones Industrials or the S&P 500 index, because then you're comparing apples to apples. Most investments fluctuate in value, and there will be good years and bad years. The way the investment world works in general is the good years make up for the bad years. So the fact that you've had a couple of bad years doesn't necessarily mean that your investment management or your investment advisor's investment management wasn't good. It just means that it was a bad period of time and that things will get better later. I suggest to most families that they keep a simple statement of net worth. And all that is kind of a list of these are the things we own on the top half, and on the bottom half, these are the things that we owe. So if you've got something like your house and you've got a mortgage against your house, on the top half you'll show the value of the house, $100,000. On the bottom half you'll show the cost of the mortgage, which is $60,000. And so your equity in that house is $40,000. If you use that statement, all your bank accounts, all your savings accounts, all your mutual funds, your investments, the value of your house, the value of your cars. And then on the bottom half, you do the loans against your house, the loans against your cars, any kind of credit card balances you have outstanding. And then you compare those, you'll find out that you have a family net worth of X dollars. Let's say it's $50,000, okay? Now for whatever period you're conducting a review for, you need to do the same thing again, and you need to see how you compare to the same period last time. Now, what I have seen in almost 30 years of practice is that most families have a rising net worth over time. Now, there will be periods of time for most families where that doesn't happen. An obvious one as I sit here today is if you're going through a divorce and you're basically splitting your assets. When that happens, you'll probably see that decrease in your family net worth. But the point is, if you aren't conducting these reviews and you aren't doing the comparisons and you aren't looking to see where you are, then it's very, very difficult to see whether you're making any progress. That's what we're trying to do. We're trying to progress from today to where we want to be tomorrow. And a key element of that progression is to sit down and do a review and look at where I've been and look at where I want to go and look at where I am in between. That's it for this week. Money Made Easy. Dan Danford with Dad's Divorce. We'll see you next time. Thank you.